Summer range trading continues as Bitcoin consolidates between 100 and 110k. War escalation in the Middle East triggers some hedging flows from funds and flips short-dated skew back to puts, but absolute volatility levels remain low, whilst the 100k support still holds. Ethereum vol still trades at a huge premium of over 30 points, but for now, it's backed up by the realized moves. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave from FRNT. How's it going, man?
Good, yeah, very good. Yeah, you? Very casual today?
Mate, have you seen what it's like outside?
No,
it's like 30 degrees.
It's like we're back in Dubai.
It's like being on holiday again.
Yeah. Although summer, it does feel a little bit like summer lull in markets.
Very much so. Very much so, yeah. Bitcoin can't really shake the range right now.
No, and every time we look like we're going to break out, then we get either tariff headlines or now geopolitical headlines, which just frustrates the move, which is...
Yeah, I mean, they are scary headlines, right? I mean, a few years ago, if people... I mean, it does seem to happen every year, right, between Iran and Israel, some sort of spat. But I don't know, I kind of feel like the market's less sensitive to it than it often is, right? Because people are so used to fading geopolitics that it's become like a reflexive thing. It's like, okay, well, we're going to drop and then we're going to bounce straight back. So why bother selling anything in the first place?
Yeah,
you know?
well, we've had, like, obviously, over the past year, a couple of these sort of flare-ups, and we've kind of sailed through it. I think as well, people now understand that, you know, I mean, I always sort of joke that, you know, if there is a World War III and nuclear war, then your puts aren't really going to help you too much.
Yeah.
And it does ultimately lead to more, money printer go burr, and sort of more debt and more financing of these wars. So there's kind of a positive risk angle to it in a world that's a function of liquidity.
If you look back at past wars, usually markets rally when the war actually kicks off, right?
Yeah.
It's like the uncertainty that comes before it makes people de-risk and get nervous.
Yeah.
But once it gets announced and it turns into a hot war, often markets rally back as like kind of relief rally because it's the end of the uncertainty, especially if it's a war that is kind of predicted like to be very one-sided.
Yeah.
And you kind of know that it's going to get resolved fairly quickly.
Yeah, exactly.
Right.
And then Bitcoin's kind of, and because I've had a few questions around this in terms of, we've been talking about how, Bitcoin's become this kind of almost safe haven play, and its sort of resilience that we've seen, like certainly, past the inauguration and Liberation Day sort of sell-offs. Yes, it got hit, but relatively sort of performed quite well. Mm-hmm. Gold obviously sort of rallied on the news of the invasion. Bitcoin sells off, but I think short term we're still very much in that knee jerk. Like the short term traders still treat Bitcoin as the risk proxy. Knee jerk, we sell off. But and then I think the kind of those safe haven, non-sovereign, borderless bearer like asset characteristics that gold has. I think once you've had them knee jerk sort of trader reactions and leverage gets wiped out, you get the real money start to come in. What's going to be interesting over the next few weeks is, in past instances, we've ended up trading sort of through the highs that we were prior to the headlines sort of hitting the screens. So we'll see how we go on that. My guys at FRNT Financial were pointing out as well, like when we had the invasion in April last year, Bitcoin sold off around 13%. This time we sold off, about 5%. So we definitely, Bitcoin's definitely more resilient to these headlines and to these risk-off episodes. But again, it's still like the knee jerk. It's the high beta risk is the knee jerk, and then I think you get the the sort of what I call the real money sort of comes into it. So it'll be interesting to see how we go. putting all that to one side, the underlying macro continues to look really, really good.
We got low inflation prints last week, didn't we?
Low inflation prints. I mean, we've been saying about this, like, I kind of dismissed the idea that tariffs would be that inflationary in a way, because again, it depends how much gets passed through. You've got the offsetting demand weakness, all these things. And there's just no sign of it at the moment in the data. So we've got the Fed, tomorrow?
Do you think there's a potential dovish lean coming out of that Fed?
I think the dovish lean will be that they have to market their forecasts almost, and their forecasts for inflation were far too high. So just given the inflation prints that we've had, they're going to have to market their forecasts and lower those.
Right.
So I think that knee jerk on the forecast, Fed have lowered the inflation forecast.
Yeah, that might price in a bit more cuts.
But that aside, I don't think much from the Fed's point of view has probably really changed. There's still a lot of uncertainty around tariffs and at what point that starts to hit. Labour market softening, but it's still resilient. So I think the Fed will still be very much in wait and see mode. Market's price for pretty much for September cuts, which looks probably about right. I think we were then pricing after the data last week back-to-back cuts, September, October. But we're pretty much priced for 2 cuts this year.
Yeah. But you think we get more, don't you?
I think if we continue to see this softness in the labour market and this sort of disinflation track, I think the Fed will feel comfortable sort of going. But right now, to be priced for around 2 cuts seems about right. I don't see why the Fed would want to sort of change that.
But the tail risk on that is for more cuts, not less, I guess.
Yes, yeah, right? I think so, because the softness in the labour market. You're seeing sort of job continued claims continue to just edge up. There's definitely softness in the labour market. Non-farm payrolls have sort of been again to the softer end of things, but again, nothing dramatically so. So I think they'll be looking at things are resilient. There's no need to but I still think real rates are too high. And when you start to think about wanting to that sort of nice sort of smooth landing, which hats off. I think Jay Powell's actually sort of done it quite well as we are. But I think you want to sort of keep on that and just keep sort of chipping away with the cuts, just given the softness that's still there. And then when you look elsewhere, we had more deflationary data out of China. So China are still sort of pushing this deflationary wave across the world. We had soft data out of the UK, negative GDP, poor employment numbers. So the major economies in the world are still going through this slowing disinflationary process. So I think we're still moving into a world of easier policy, and the Fed will kind of be a part of that, which again, from a risk point of view, makes everything for me just look pretty good. Particularly important as well is the dollar's still falling. I think that's what's been really interesting.
No safe haven bid at all for the dollar.
Yeah, none. Which makes me...
Same with Treasuries, right?
Yeah. It does make me feel like, has there been some kind of backdoor Shanghai Accord type agreement on the dollar? Because it's just curious when it doesn't rally, when we've had some of these sort of big risk off events.
It might also be some of these big pension funds that are using it as an opportunity to kind of diversify out. No, I don't know.
Yeah, I just find that story hard to kind of equate in my mind, because again, what are you buying?
No, because all these pension funds, like Canadian, European pension funds, they will hold a load of US assets, right?
Yeah.
And then a lot of them, they kind of don't hedge the FX, or the amount of the FX risk that they hedge is kind of debatable, right? So in a world where, it's guns blazing, US exceptionalism, all good, maybe their hedge ratios are a bit light.
Just reducing the hedge ratios.
Yeah, so now they're saying, okay, well, the US has shown itself to be a bit erratic, right, in terms of the Trump administration and what they're doing. Do we want to be as nakedly exposed to the dollar as we were? Probably not.
Yeah.
So then we're going to up our hedge ratios, because we still hold a certain amount of US assets. Yeah. They're not going to dump all their tech stocks or anything like that, right? But they might be a bit more comfortable holding those tech stocks in the US, but also having a hedge on that against the dollar movement. So I think that's keeping a bit of a lid on the dollar right now.
Yeah, and whatever's driving it, and I think that's reasonable. I certainly think that in Japan, that's what's been going on. Again, you just increase the hedge ratios, protect yourself on the dollar move. But again, like from when you think about how that feeds global liquidity, global financial conditions, again, that's just adding to that sort of momentum. So that's why I still think we're in a very good environment for risk. Say global easing, slowing, not collapsing US economy, disinflationary economy, always looking good. I think the one area of concern with the Iran war is always oil. Again, there's been some stupid forecast for oil.
120 or something, yeah. I think JP were out saying it could go to 120.
Yeah, I mean, like a massive yours on that.
You never know.
You never know.
For a day, it might go there for a day.
Yeah, but I guess the fear is with this war is if Iran block or close the Strait of Hormuz.
Yeah.
Which, again, no expert on any of this. I think, firstly, they'd really piss off China if they did that, who import a lot of oil
and they probably need an ally like China, don't they?
Yeah. It's quite interesting that China have been pretty quiet on all of this as well, which makes me think it's a fade.
Right.
And then the other things I think on that is, I think it's just practically it's very difficult for them to sort of close that strait. So, assuming oil continues to flow through there, I think 20% of global oil sort of moves through that strait. Then oil's not going anywhere, and you still got OPEC looking to pump, and essentially I always say they're printing money is printing oil, and they're needing to do that as well. So I'm not overly concerned, but it's definitely a risk, obviously.
Yeah,
and again, weaker oil alongside a weaker dollar is like kind of easing global financial conditions, which keeps us pretty positive risk. So that would be a risk factor that if we did see a sustained sort of move higher in oil, then I think we probably could be a little bit more cautious risk. But right now, I think you fade the geopolitics.
I mean, in terms of the option flows that we've seen in the last week, there's definitely been some hedging flow. Right, which you would think makes sense, right? Like market kind of ran out of momentum at around 110k, and that was before this even kicked off, right, in the Middle East. And now this has kicked off, so people are like, okay, we need some protection. So short end skew has flipped back towards puts, as it always does when the market has a bit of a wobble. But vols have been pretty muted, and that's because people are not just going and buying a load of puts; they're doing it via risk reversals. So they're buying and they're buying very short dated, right? They're buying June expiry stuff. So 1 to 2 week stuff. They buy the puts, they sell some calls to finance it. They're relatively vague and neutral, but they've got protection if this thing starts to melt down, right? Even I did the same thing. Yeah. I run a hedged crypto strategy for some of my Bitcoin holdings. So I was running short some June calls, the 110 calls. I didn't really have any puts on. So my hedge was just like a call overwrite, basically. It wasn't really a proper hedge. But when this stuff started to happen, I was like, okay, I probably need to have some puts now in case this becomes a bigger move down, because my delta on my short calls is going to evaporate very quickly because it's decaying away every day. So I've rolled the whole structure to a July risk reversal, and that's a similar sort of trade that all the funds have been doing and putting their hedges in place, basically.
Yeah, and it's very easy for me not managing money for anyone other than my own to be you fade geopolitical risks and you buy the dip.
Yeah, because it's drawdown management really that we're talking about.
If you're a fund manager right now, you're getting tapped on the shoulder to say, look, what's going on in Iran? Yeah. For now, you just gross down risk.
There was a huge tap on the shoulder last week in S&P. S&P downside puts went ballistically last week. Like very, very short dated stuff. We've got an expiry on the S&P this Friday. The options expiring this Friday on the downside went absolutely nuts last week. Yeah. Because everyone's risk manager gives them the tap on the shoulder and says, what's your downside look like? What's your downside look like, right? It's the first thing.
So you have to have something in there. Yeah. So I think if we ease past this, see what happens this week and
touch wood.
Hopefully something gets resolved there. Then I think it's going to be really interesting because I still think post-April markets are really under position risks. I think the market is underweight and still effectively sort of short risk. And we're coming into the end of a quarter and first half of the year, I think there's going to be a lot of performance chasing. So I think you'll see those hedges get unwound pretty quick, and then maybe like a little performance chase into
so like a little July, August rally, basically.
And because
get June out the way, right?
But because if you remember, in April we were priced for COVID level type stress. Never materialised, and we've we're only a couple of % off record highs again on everything.
Yeah, it's funny, like the whole trade all the trade stuff. There's no trade deals been done, right? It's kind of gone on the back burner.
Yeah, and then Besson as well. Like these are other positive things. Obviously, it sounds like the US and China are sort of progressing. Again, we're always fearful that at some point Trump throws his toys out the pram. Besson made some comments last week that they can extend that 90-day deadline for those that are negotiating in good faith. So it doesn't look like we're going to hit a brick wall, right? We haven't got a deal. So
the July deadlines are just going to get rolled.
And the more we see these delays and those cans kicked down the road, I think the more the market will be less sensitive
I agree.
to when Trump comes out.
So
I think if we can get through this Iran, Israel geopolitics, then I think we're still looking pretty good for risk. Again, my issue now is what sparks the next leg higher other than purely people chasing performance.
I mean, the resilience that you mentioned as well, Bitcoin has shown, I think it's partly just because there is just steady inflows, right? From all these corporates that are buying it now, all these new Treasury holding companies that want to hold Bitcoin, right? There's more and more of them doing the Michael Saylor trade, right?
Yeah.
So I think if that just continues to keep coming, and then it soaks up some of the selling pressure, and then it just continues to take everything higher, right? It doesn't have to be like this explosive move, speculative explosion higher. Because we haven't seen that, right? We thought we were going to, when we went to new highs, it'd be explosive. But it wasn't. It was kind of a grind higher. So maybe that's what we get over the summer, right? Yeah.
So we should be a bit of a short vol trade, but, directionally
Yeah, I mean,
long.
vol's not exactly expensive, though. So you'd rather sell it when it had a pop, but it's just not popping. Anyway, this week's special guest I had the pleasure of interviewing yesterday was Charlie Sandor, investment manager at CMT Digital. They are venture cap and prop trading. Have a look what he had to say. All right, everyone, we are back, and today's special guest is Charlie Sandor, investment manager at CMT Digital. Welcome to the show, man.
Yeah, thank you so much for having me. I'm excited to be on and have a great conversation today.
Yeah, good stuff. So, before we start, why don't you tell us a little bit about your kind of background, how you got into the space, and what you guys are doing over there at CMT?
Yeah, happy to do so. A quick background of myself. I'm based here in Chicago, where our headquarters are for CMT. Prior to working at CMT, I did a little time at Susquehanna doing equity research, and then I primarily worked at Bain & Company, the management consultant firm, where I did kind of the classic mix of traditional consulting with Fortune 500 companies. And then the latter half of my time there, I spent it in their private equity group. So doing a lot of commercial diligences across industries. And that really piqued my interest in going to the buy side, especially kind of in the tech arena. And then an opportunity came up here with CMT Digital right at the launch of our fourth fund in 2021. So I kind of jumped in 2 feet first. I actually had pretty minimal background on blockchain ahead of that, but definitely was trial by fire in the 2021 era. And then I've been with the firm now for 4 years. And then a little kind of more context is CMT Digital is the blockchain focused kind of arm of the CMT group, which is a 27-year-old proprietary trading firm and investment firm. I think we've operated about 15 different countries across the globe. And today we have offices here in Chicago. We have one in London, Frankfurt, as well as a recently opened one in Singapore as well.
So the prop trading, there's a prop trading arm is that like a market making type outfit as well? And then there's the venture capital side?
Yeah, so there's kind of three elements. There's the prop trading arm that was the original group, and that started in Frankfurt, Germany in 1997 with kind of the onset of electronic trading. And the groups kind of evolved over the years, spun up, spun down different strategies at desk, and kind of just always been at the forefront of the capital markets space. And that's what brought us into crypto pretty early on. Along the way, I think we started looking at Bitcoin back in 2013, 2014. And then we spun up a prop crypto trading desk alongside kind of our equities desk. And then our two co-founders, Scott Casto and Jan Dirk Luters, realized the opportunity within blockchain was quite massive and much larger than trading itself, which led to the genesis of the venture group. And then the third kind of component of the group is a private equity arm. And that's a little bit uncorrelated to tech. It's mainly lower middle market, majority positions in middle US companies that are kind of uncorrelated with any kind of cyclicality.
Okay, so you've got an interesting vantage point in the space, right? So, with all the institutional adoption that seems to be happening now, certainly through like the ETF inflows and stuff, are you seeing much changes on your side in terms of like, are you competing for deals now with other people, whereas before there wasn't as much competition and it was easy to get into deals and stuff? Is it now a lot harder?
Yeah, I definitely think, we've always been one of the core areas we've invested in is kind of the intersection of TradFi and crypto and that CeFi arena. So we're like early investors in companies like FalconX, Coinbase, more kind of institutional oriented, or ArisX, which the SIBO bought. And I think you see that, which historically was, I think, less interesting to crypto native venture funds, becoming much more interesting as opportunity set for outcomes and just general adoption has increased massively. I think one of the nice things, we have a bit of an edge there because we're users of a lot of these platforms, which is a huge unlock, kind of understanding, does this platform kind of have the right product, right feature set that an institution will actually use it, or is it more or less unusable? So that's a big kind of way of diligencing and also deal flow for us. If our trading desk comes across like an on-chain perps or an on-chain options platform and they're like, oh, this is great, like we're probably going to onboard and use it, then we kind of dive in on the diligence side, and vice versa. If we come across a platform and flag it to our trading desk and they're like, no, this doesn't really solve anything for us, or it's just not up to par for any institution to actually use it, but the protocols looking to target institutions, then it's usually a pretty quick pass on the diligence side.
So when you say, there's some things you'll look at, you'll be like, this isn't really usable, or, because you are in that position where you know what you need, basically, right? Is there a lot of things out there that you would say get rejected quickly? Like what percentage of the stuff that gets presented is actually worth investing in, would you say?
Yeah, I think I'd probably put it 50-50 because there's a couple facets, right? Obviously, when you're looking at a pre-seed or seed stage startup, not everything's going to be baked. And then part of it too is the timeline. I think that's one lesson we've learned is you can be directionally correct, but is it 2 years out? Is it 5 years out? Is it 7 years out? So I think in our first fund, even predating me, we made kind of a tokenized asset play, like tokenized securities back in 2019. Clearly, that specific investment didn't pan out, but directionally, I think the idea is correct. Tokenized securities are going to be quite a big thing. It's just taken longer, given kind of the regulatory kind of tape surrounding that. And I think by the end of this year, right, you're going to have a market structure bill. So for us, that those types of investments are extremely compelling today because there's a pretty clear sight to having that be a viable path for startups or even like stable coins, right? Now with the Genius Act pretty in the final stages within the US, you just see demand and interest coming across. I mean, Coinbase just had their recent day, right, with Spotify rolling out Shopify rolling out stablecoin checkouts. And like that wouldn't really be possible without the regulatory clarity provided by the Genius Act that hopefully will be passed in the coming months.
And the Circle IPO was crazy, huh?
Yeah, it still is. I don't know if you looked at the stock today, but it's up quite a bit this morning.
Is it? Yeah, no, it's incredible. I mean, I didn't get in on it annoyingly, but I don't tend to get into IPOs, but I couldn't believe how much that thing multiplied when it came out. But what is the deal? Like, was that just completely mispriced, do you think?
Yeah, so I think there's a combination there. We're our fund one's an investor in Circle, and I think when they filed their S1, a lot of people were concerned pretty heavily around their rev share agreement with Coinbase and how that's kind of divvied up with any kind of USDC that is originated on Coinbase. They get access to the net interest revenue generated from it. But what I think is driving a lot of the demand from my perspective on Circle is they're at the front seat of opening up the U.S. economy to stablecoins, right? Given, I think in the Genius Act, non-financial institutions can't issue their own stablecoins, so they'll have to partner with somebody. And in that scenario, right, there's 3 or 4 big players today. Obviously, I think you'll have more in the future, but Circle's kind of the front runner there. So I'm sure there's a lot of institutions and public companies who are inquiring about partnering with Circle in some capacity in the stablecoin arena, and I think that's probably what's driving a lot of the demand. But again, that's not any financial advice, and we'll see how they perform over the coming months.
So, like Trump kind of ruled out central bank digital currencies in the US a while back, right? So it's a case of the version of the central bank digital currency could end up being something like USDC, where there's kind of a partnership with the government. And so there's some like level of kind of control or guidance the government can give them, that kind of becomes their way of having like a central bank digital currency. Do you think?
I don't see it going down that route. It could. I just don't see the government getting involved in that way. I think the leverage, well, the kind of the having it be a US based company is the most important thing, right? And then now that's a publicly traded company. I mean, Circle has always responded to kind of requests from the feds or the government when it comes to freezing wallets or anything on that front. But I just don't think the government will probably crown a winner, just given kind of that's anti-private markets and anti-free market ethos. And I'm sure you'll see a lot of the kind of incumbent financial institutions look to launch like a USDC competitor. To be determined when that occurs and if it really is as successful as USDC across the crypto landscape, right? I think USDC has done a phenomenal job of being available across exchanges, across chains, where I think competitors in the future will probably be more permissioned in a sense or used for bespoke use cases, whether it's for like specific B2B remittance or treasury management, than kind of just a broad-based general use case stablecoin. But I don't see a future where the US government kind of crowns a singular stablecoin as like the US stablecoin.
Okay. Yeah, it does look like certainly the first part of the regulatory clarity is very much concentrated around stablecoin use. Mm-hmm. So, and it sounded like, correct me if I'm wrong, it sounded like you were saying by the end of this year, we're going to kind of know where we stand, right, on all of this stuff. But
yeah, correct. It's the Genius Act, which I think the goal that the administration has stated is they want to get passed by this fall. So August, September timeline. And I think they kind of did the stablecoins first because it's very concrete and it's kind of a singular issue. And then in the pipeline, and they just came out with a draft, I think last week, is kind of the regulatory market clarity bill, which will kind of talk about how you issue securities on blockchains, what's a security, what's a not security. And I think that probably has a little bit longer timeline just because of how much is going to be flushed out in that bill. And then that will determine whether it's the SEC or the CFTC who kind of overviews what. I think that will probably be towards the end of this year, early next year when that gets passed.
And is that the regulatory clarity we need to really see how the kind of altcoin space shakes out, right? Because we've been in a bit of a bear market in alts for ages now. Mm-hmm. We've been waiting for this. Now we've had a bit of a pop in Ethereum recently because it was really up, but that seems like just a bit of a readjustment rather than necessarily the start of something. But do you think that could be the start of some sort of altcoin summer, like early next year?
Yeah, I think so. And I think what it does is it lays out the path for altcoins and protocols to really be able to experiment with their token more so than it's been allowed today, right? And have access to the US market. I think it allows companies to, they'll have clarity about what you can do with buybacks, right? With revenue distribution, things like that. And I think that's a huge fundamental unlock because if you're all of a sudden Uniswap or somebody else and you're allowed to distribute fees on the platform back to token holders, there's a clear line into driving value to the token. Today, I think that's the hard part with alts. But even then, I think recently you've seen a lot of alts perform quite well when the underlying protocol has done well. So like if you look at like Maple or Euler, who both have hit like all-time highs in TVL and rolled out new products, their tokens have actually done pretty phenomenally in the first half of this year. And I think as you look into the future, Some alts will recover, some alts won't. I think the big difference between today and 2021 is the market has been saturated with so many more projects where there's only so much capital. So it's where does the capital flow? And our thesis is pretty strongly that it will flow to the best in class projects that have a really tangible fundamental product that's working well. And you can track that. The nice thing about a lot of these protocols is you see all that data on chain, so you can very clearly track when protocols are doing well and kind of hitting an inflection point.
What are like the metrics you would look at to decide whether a project is a good value proposition or not, basically?
Yeah, that's a great question. We focus that a lot because obviously we're primarily venture, but we also have the ability to put on in liquid investments occasionally. So some things that we look at is like TVL growth, right? What is just kind of that natural inbound. Another one is protocol revenue. So if you're looking at something like Athena, right, you can kind of back into their revenue based off of their take rate and generally what interest rates they're able to generate, whether they're kind of at the 4.5% or they have excess due to the basis trade arb. And that's all really important, but then also understanding how the team thinks about that revenue share or accrual to token holders. So is there a path where it's accrued to like a treasury and the token holders have rights over that treasury? Is there a fee switch in the future, or does all that revenue accrue to the equity entity where the token has kind of less importance? All of those are factors that we look at and study quite hardly. And then alongside that, I think one thing most people overlook and don't consider enough is what is kind of the causal reason of the increase in TVL or the improvement of metrics. Is it because it's the best product in the space and people are naturally moving flows there? Or is it because they're subsidizing growth with emissions? So something we look at quite heavily is what are the token emissions of the native protocol, because as a token holder you're essentially getting diluted by emissions, but is all the growth really just subsidized by them issuing new tokens and basically giving it an incentive? And we found for a short period of time, right, people will see that the TVL or kind of metrics or the key KPIs increase, but it's really artificial and it's not organic, and that's not sustainable over the long run.
Interesting. So that's the sort of little telltale signs that you look for like red flags, basically, right?
Red flag. Well, I don't think I wouldn't say it's a red flag, but it's kind of one of the key components that we kind of factor in when we're evaluating a liquid token and what we think on it.
Interesting. Okay. And just sort of broadly, like for the space, I mean, are there any, how we had this big lending boom with FTX, post FTX, now that kind of people started to trust again in the space, right, after all those entities went under. Are there any like hidden sort of black swan risks in the system, like building anywhere, or do you think it's kind of being built up again from a much more stable foundation, and kind of bad actors can't really get away with the type of stuff that was going on before, so we don't have to worry so much about that?
Yeah, it's a great question. Obviously, there's always unknown risks, especially like if you've been, as you know, like when you're in the blockchain space long enough, there's always things that you aren't thinking about that come out of the blue. I mean, for example, like Silicon Valley Bank had a pretty big impact on the crypto space and like the depegging of USDC, but that was fully kind of unrelated, and I don't think anyone would have predicted that outcome. But as far as like lending and leverage, I think the space is in a much better spot today than it was in 2022. I think back then there was a lot of kind of centralized lending and risk hidden that no one really had clarity on. And today those companies just, if they're a centralized lender, they're very strict on what collateral is, right? You don't see them taking altcoin risk and kind of long tail assets that don't have much liquidity. It's pretty much all based off Bitcoin and then to some extent Ethereum. So kind of the blue chip assets with significant liquidity. And then where we've really seen an uptick in lending is the on-chain markets, which are great because you can see the risk and make your own decision of whether or not you're comfortable lending to that counterparty, and it's not abstracted by some centralized entity. So no, at this point, I don't think there's kind of a black swan event hiding in the wings. I think a lot of that leverage and risk was wiped out, and hasn't really been built back in, and rightfully so. But yeah, that's generally my view on it right now.
Mhm. And on-chain, you mentioned on-chain stuff, like the on-chain exchanges, like how do you see their role relative to, say, something like a Deribit, right? Like, can you really see these on-chain exchanges kind of taking over in terms of volume or anything like that? Can they really compete, or is it just a very special niche type of consumer who will want to trade on those sort of things?
Yeah, I mean, I definitely think they can compete. A great example, right, is Hyperliquid. Hyperliquid become the dominant decentralized perp exchange, and they've taken quite a bit of share of the overall market share. I think the biggest blocker there, or I guess the biggest thing that needs to be figured out there, is how you onboard a lot of institutional traders and institutional market makers to an on-chain exchange. I think there's a couple ways of doing that, right? I think over the last 2 weeks, both Coinbase as well as Bybit have announced integrations of decentralized exchanges within their existing platforms. So I think you kind of will see it approach from two different ways, where you have these centralized exchanges become more integrated with decentralized exchanges and DeFi protocols. Coinbase also rolled out kind of that lending capability with Morpha, which has been pretty successful. I think they have about 500 million in collateral in that lending agreement. But really, for like a truly decentralized exchange or decentralized finance protocol to reach those levels, they need to figure out the compliance and like the proper reporting infrastructure. I think that's the biggest blocker. When you talk to a lot of these regulated entities and kind of traditional prop shops, they don't have comfort fully from the compliance angle. And I think you will get that with the stablecoin bill coming out, with the market structure bill. That will give kind of a path to like, okay, we can get comfortable with this without exposing the broader firm to regulatory risk. And then I think you'll see it come down to what exchange has the best execution, right? Which really has the best product. And so I definitely think there's a viable path there.
Okay, cool. And again, being in venture cap, so you must see quite a lot of you're at that kind of front edge where you probably see a lot of like projects coming which are a bit innovative and they're trying to do things that haven't been done before. And are you seeing anything come across your desk that is really caught your eye in terms of innovation and something that could really shape the future of the industry that people aren't maybe thinking about that much?
Yeah, that's a great question. I mean, we pride ourselves, and we have a pretty technical investment team with our head of research and a few research analysts on kind of looking at the future, right, and understanding what could be really disruptive down the road. And I think there's a couple areas that we're quite keen on. One, obviously, there's been a lot of investment around kind of Bitcoin L2s. We haven't really made a bet there yet, but we think there's a ton of potential if someone can successfully unlock that with keeping the trustless nature that the Bitcoin network provides. That's one area that I think we're actively looking for, kind of where we want to make a bet. On top of that, there's parts of AI and crypto that we stay very far away from, because we just think there's not, in the near term, kind of a legitimate prospect there. But there are very interesting things, like if you look at, I think Pluralis is one, and then also I'm blanking on the name, but they do decentralized training and allow for models to be kind of trained on a decentralized compute basis, which we think will be massive in the future, whether it's fine-tuning or running inferences across a decentralized network. I think there's a lot of concern on the hardware side, right? As we reach limits on AI training, where's compute demand going to come from? And it was very clear, like, to us, inferences are going to outpace any type of training demand into the future. Like, as the capabilities of these models improve across image generation, video generation, and just general compute, the demand for inferences will far exponentially increase, which means compute increases. And then how do you coordinate compute on a global scale on a decentralized manner? It's virtually impossible to do it without a blockchain substrate. And so that's another area we're pretty excited about. And then also, to just as like data authenticity and data verification as you have deepfake technology increase and all of this. It's like, how do you solve for that on a long-term basis? And again, we think using like blockchain is the proof of digital ownership. And so having a blockchain ledger to ascribe that on a cryptographic nature, I see, in my opinion, it's a no-brainer, right? Where every photo you take on a camera or something will be inscribed with some cryptographic mark of like, hey, this is a real photo taken at this time and hasn't been digitally altered, because the world needs that. And we've 100% of that. Yeah.
100%. Yeah, because that's the world we're heading into, right? I mean, you won't know what the hell's real or what isn't. And if there's and if that's the solution, I mean, yeah, that's going to be a no-brainer. I think that's a really good point, Charlie. This has been a fantastic conversation. I really appreciate you sharing your insights and the type of stuff you look at when deciding to, what to invest in and stuff. Thanks for the show.
Yeah, thank you so much for the time. It's been great chatting.
All right, I'll see you soon. Cheers.
Awesome. Thank you. Bye.
All right, so what do you think? It's quite interesting convo, eh?
Yeah, interesting stuff. Interesting, like, to hear kind of, where they're thinking, the next big things are.
Yeah, I always love to ask that question for people who are in that part of the venture cap world where they're seeing all these things. For people want money to invest in their ideas and stuff.
Yeah, and I know, like, we've had people on here talk about like deep in like the decentralized physical infrastructure. The decentralized compute is obviously just going to be a massive thing, right? With AI, which is, just that's the big exponential trend, right? So I thought that was really interesting, and then like the verification of data and
that was the biggest. I think for me that was the biggest no-brainer, right? Because I mean, a good point is that this Israel-Iran conflict that's going on, right? We're all watching like X and we're all watching all the stuff that's coming out, and it's really hard to know what to believe because there's so many conflicting. Like, there was an article in the Wall Street Journal yesterday saying that Iran were ready to negotiate, and then that gets denied, right?
Yeah.
You don't really know what's real and what's not, so you kind of want to know what the sources are for the content that's out there and be able to verify that yes, that came from that source, and then if that's a source that I actually do trust, then I'll believe it, right?
Yeah.
But if that's a source that I think is biased in some way and trying to spin a narrative, then at least I know where that came from. You know? So I think it's quite important.
Yeah, and like, I don't know about you, but like constantly now, like, I'm seeing things, and it could be an interview or whatever, and you're kind of asking, is this AI generated? Is this real? Or did they actually say that?
And that's only getting better. The quality of the AI deepfakes is only getting more realistic.
Yeah.
There'll be an AI version of this podcast at some point.
Yeah. So it'll be like Dave Brickell's bearish on Bitcoin. I was like, I never said that.
So that would be easy to spot. That would be the easiest one to spot, that will.
But then the question will become, because there will be a time when the macro dynamic changes.
Yeah.
Which will probably
when the facts change, I change my mind.
Yeah, and for me, like we spoke about this before, that'll be when, when we near the end of the cutting cycle and we look back to a kind of hike cycle, which is probably late next year, I would imagine.
Yeah, I think I could see Dave Brickell turning bearish in 2026.
Yeah. So then we almost want to verify, like, I did say that. Yeah.
Brilliant. All right, I think we'll call it a day. I think that was a really good one, but. Enjoy the weather out there if you guys are in the UK, because it's probably only going to last a week or two. And we'll catch you back here next week. Cheers.